Hello and welcome back to All Things Money. I'm your host, David Blain. During this segment, we're going to continue talking about some behavioral finance issues, things that investors do that are against their long-term financial good. And one of the biggest things that I talk about quite frequently is the constant 24/7 news cycle of finance, CNBC, things like that, to a lesser extent, Bloomberg TV. If we go back to when the stock market collapsed 22% in October of 1987, most people read about it the next day in the newspaper, believe it or not. Remember when people used to read the newspaper, there was no internet, no cable TV. Well, actually there was this thing called Financial News Network. It was a new cable network, and there was also CNBC had just started a few years before, but they were, really not that popular at the time. But in 1991, the two merged. I think CNBC bought them out. I think Financial News Network went bankrupt or something, so they bought them out, and so we see CNBC gaining prominence as the bull market of the mid to late 90s continued on. CNBC became a fixture in most people's home or even businesses. You go into businesses that have nothing to do with finance. You go into restaurants. You go into, everywhere today. You get on a subway. They have TVs there. They have TVs in the restaurant, TVs in the subway, TVs in the airport. Everywhere there's a TV. And a good 75% of the time, CNBC is on there, which, by the way, CNBC, they don't make a whole lot of money from their show, but that's a topic for another day. CNBC's primary, if I could summarize it in one sentence, what is the purpose of CNBC? It is, what should I trade today? That is the existence of CNBC, sort of the underlying theme of all the shows. They have different shows, they have different commentators, they have different guests, but it all revolves around this common theme of what should I trade today? And when markets get extremely, volatile and things like that, you'll see, I've seen, I don't actually subscribe to CNBC, but I've seen it in other places that I've been. Like I say, you can't get away from it. I don't subscribe to it at home. We don't have it at the office, but you can't get away from it. I remember seeing one time, there was like 10 talking heads on the screen at once, and, they're all going back and forth, yelling at the same time, and, it's great entertainment, but the informational content of that sort of show is zero. I believe that most people have no business trading. They're mostly, whenever a stock is bought or sold, there's someone on the other side of that trade. And if you're buying and selling stocks on a frequent basis, day trading, things like that, most often on the other side of the trade is some high-frequency trader, some hedge fund that is just stealing your money. The people I need to say that the people at CNBC and the producers and the people they have on the show, I don't think they're malicious at all. I don't think they're intentionally misleading investors, that they truly believe that they're providing, quality advice and a quality service to the investing public. And there is something to be said. There's a theory in finance that if you didn't have people trading all the time, you would have a less efficient market, and that's somewhat true, except when you get into the herding. But so, having daily liquidity for your investments is not such a bad thing. So in some respects, they are providing a decent service to people. But CNBC is in the business of providing ratings to the advertiser, primarily brokers whose income is trading on commissions. You see TD Ameritrade, they've got their trading tools. They've got those little baby ads on, and of course Charles Schwab has their series of ads. And so the big brokerage houses make money when people are trading. Of course, then there's Jim Cramer. I've read Jim Cramer's books. I have seen his TV shows, and it's a shame because he's a very smart, talented person. But I think he should have remained at his hedge fund. That for the majority of average people watching a show and trading, it's just been a negative experience for them. There's a website out there, I think it's called, it's something Guru Tracking or something like that tracks these gurus and their predictions, and one of them being Jim Cramer. I've looked at it before, and if you were to follow his advice on CNBC, I mean, you're just not making a whole lot of money. And, maybe one person in 1,000 after years and years of practicing those skills could obtain some level of proficiency. In fact, I read somewhere one time that it takes 10,000 hours of doing something before you maintain a level of proficiency. But anyway, so I think his show does more harm than good for people. The daily focus on CNBC recently seems to be whether the risk trade is on or risk trade is off, and it distracts investors that are saving for retirement for the future about long-term investing. Now, I'm not saying you should just buy some investment and blindly hold on to it forever, but the notion that on a daily basis something is changing is not good for your long-term health. Certainly you should be making adjustments as your risk profile changes, as your goals change, as the capital markets change. You should certainly be making adjustments as you go along, but not on a daily basis. Things don't change that much. Happen to think that for the people with a decent long-term horizon, that this now will turn out to be a good time to be investing. We see, if you go back in history, both in the U.S. as well as around the world, that money in risky assets tends to be made in spurts, that you have multi-year period of times where virtually no money is being made, which is the time period we're in now, which should get someone excited that is not actually trying to spend their money today. Now, it's a little bit different if you need the money to spend today, but if you're investing for any point in the future, 5, 10, 15 years from now, it's actually a very exciting time to be an investor, because at some point in the future, things are going to turn around and get much better. Well, that was kind of a brief overview of behavioral finance. We want to talk a little bit next week about modeling in finance and some of the false precision that comes along. Having an engineering degree, sometimes we try to apply some of those factors to finance, and they just don't work out the same. So we hope that you'll come back again next week and join us. We've got a great show lined up for you. So for All Things Money, I'm your host, David Blain. Have a great week, and we will see you again, same time, same channel.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.